Bernanke. For more on Bernanke, we're going to bring in David Malpass now. He's president of Encima Global. He says the basic issue that Ben faces is another challenging 4 years, and David has really been focused on the dollar recently. And I want to start right there, David. What do you think the reappointment of Ben Bernanke says? Is it a statement of satisfaction with the status quo? Because if that's the case, and you're arguing for a stronger dollar, you can't be a very happy camper.
That's right. Now, Bernanke met with President Obama, we learned last week, and we don't know what that conversation entailed. If there was discussion of the dollar, I take that would be a positive, because at least they'd be considering a change from the Bush administration. But I think we have to assume that they didn't discuss it, that it's go with the flow as far as the dollar weakness is concerned. That means oil stays high, the dollar stays weak, and importantly, capital flows out of the U.S. This huge power behind Australia, Canada, China is money fleeing the U.S. So will Bernanke change that? Maybe. The market gave us a reaction. The knee-jerk this morning was to sell the dollar and buy everything. Gold, oil, stock, foreign stocks, especially the euro, those were all up heavily this morning upon the announcement of the Bernanke renomination. But remember what happened during the day, the market kind of reassessed that.
Let me bring up an interview that we did earlier with Jared Bernstein. He's Joe Biden's economic advisor, and we were talking to him. Carol asked him how he plans to deal with the deficits that we're looking at. And a viewer wrote in and pointed out that Bernstein, and we, I believe, have a full-screen graphic of this, Bernstein was talking about net exports as one driver for growth. This indicates that policymakers simply count on a weaker U.S. dollar in the coming years, and I feel like that is emblematic of what we've been seeing from this administration throughout.
Yes, and the previous administration. And the flaw, I think, in that logic is they assume net exports growth without considering the capital that is needed to do that. And so if all the money is running away from the U.S., how are you going to really have any growth or any constructive growth out of the economy? Personal income is just going to be very weak under that scenario. So I think it has to change. It just doesn't work to have a weak dollar growth policy. Developing countries over and over again show us that when their currencies weakened, people got poorer and they didn't grow.
All right, so David, so when do we see the switch?
When Obama finally gets tired of this, over and over again, we've seen leaders abroad make a change in their currency policy. For example, Brazil in 2001 and 2002 had a weak currency. It meant higher and higher interest rates, slower growth, bad politics. They made a conscious change. Lula is now popular in Brazil, and they're a strong currency country. So just look down. Margaret Thatcher famously changed the UK from being a weak currency, a bad labor environment, poor country in the 1960s and 70s to being a stronger pound country and was politically popular. So
does he get tired of it anytime soon, in your view?
This is hard to say. How will he tolerate a 10.5% unemployment rate? The money flows out of the U.S. Jobs don't come to the U.S. Everybody else in the world gets the job growth environment. At some point, maybe a couple quarters, I would think the president would get tired of that and ask his advisors, why are we doing this? We're saving, are we that desperate to save a few jobs in Ohio for re-election? Wouldn't it be better to create jobs nationwide?
Let me just bring up a point that, you've been talking about this, David, for a long time coming on this show. And joining in the discussion a couple of weeks ago was Warren Buffett in his New York Times op-ed. He pointed out that politically it's much easier for politicians to let inflation run rampant when they want to bring down deficits, because they can't cut down spending going into an election, and they probably don't want to raise taxes going into an election. Doesn't President Obama face the same problem with this deficit, which, of course, then leads to a weaker dollar?
Yes, that's tempting for politicians to just make no decisions and let the trend persist. That was broken by Ronald Reagan in 1981, and he was very popular for having a stronger dollar as we moved out of the Carter malaise. So Bernanke has that opportunity, or excuse me, Obama has that opportunity. With Bernanke, they can move out of the Bush malaise. We're really in the Bush malaise right now. And the question is, will Obama decide to change that? He can do that, I think, rather easily. If President Obama said he'd prefer a stronger dollar or a stable dollar, it would happen almost immediately, because the world's money
is so short. You mean if all he has to do is talk about it?
See, it's more than jawboning. It's the statement of the policy. And so we've had for so many years a statement of a weak dollar policy that the markets begin to presume that, and momentum takes over. So people simply buy oil, as they're doing right now. Did you see the New York Times article today, the op-ed, about the logic behind peak oil? The facts just aren't there behind peak oil. And a logical price, the author argued, was $30 for oil. That presumes that, I think, is going to take a stronger dollar to get us to this lower oil price.
My old friend Charlie Maxwell isn't going to like that one bit. Let's talk about then what Ben Bernanke, what his reappointment says. I mean, do you take this as a complete positive? Because it seems like you're saying it could be good, could be bad.
I think it was a safe choice by President Obama to stick with the guy that's in the office, and then it's up to Bernanke to think about whether a weak dollar policy benefits the United States. My contention is it drives capital away from the United States, and that offsets this competitiveness issue. We haven't ever had a country that weakened its currency into prosperity. It just doesn't work.
Right?
So at some point, the Fed's got to understand that and change the policy. And it won't take very much. It just means to restate that they aren't going to do what was done on Greenspan's watch. Remember, he famously decided on the measured rate hikes, which didn't work.
We're going to take a quick break, and hopefully you have time to stay with us. We'll be right back with more from David Malpass from Encima Global. Stay with us. Back in 2. All right, rejoining us now is David Malpass, president of Encima Global. We've been talking about Ben Bernanke's reappointment, and you have an article coming out in Forbes, Armageddon Averted, or was it? And really...
Was it? Because we don't still yet know. I mean, Ben Bernanke, all these programs, they still have yet to unfold, David, right? So we don't know if they truly were successful long term.
I think that Bernanke did a good job showing and using the Fed's power after the Lehman fiasco. So Lehman went bankrupt by surprise to the markets. Stocks fell harshly, and the Fed stepped in and protected commercial paper, interbank markets, and so on. That's the correct use of massive force. But Armageddon, we're in a 10% unemployment environment. The CBO and OMB, you're going to discuss pretty soon the budget deficit estimates, and the administration is assuming over 10% unemployment. That sounds like Armageddon to me, especially when you factor in this even higher unemployment for minorities, for low income. So the median per capita income for the U.S. is just getting hammered by this recession. Pretty close to Armageddon in my mind.
You do, though, point out that U.S. economic activity is in a bottoming process, and you bring the reasons that we've been hearing from people for a while. For example, auto production is increasing here as we have the Cash for Clunkers program, and because inventories have been drawn down so much. The question is this pickup sustainable? Can we see growth going forward? Do you see growth going forward?
I'm kind of in the consensus now as far as the near-term outlook, slow growth. But the problem that I want to raise is it's not really sustainable. Much of the country has fallen below break even. For example, there was a story on Bloomberg today about manufacturing companies, small companies, not getting financed. So there's been a call for some special new government program to finance small companies. So that's an aspect of the unsustainability of this slow growth rate that everyone's projecting. I don't see how we can get through 2002 to 2010 with just 2% growth.
So what do we need? A second stimulus plan, or does that just dig us deeper into the hole?
I don't think the first one worked. In fact, remember, Bush had one in May of 2008 that didn't work, and now we've got the second one, and we'll have maybe they'll talk about a third one. I think more powerful is this regulatory process for small businesses. Somebody has to step in to the regulators in Washington and say, look, why are small businesses getting cut off by this process of capital being redirected? I think also the weak dollar is causing it. It's pushing all the capital that should be in U.S. bank equity capital and in small business loans, is pushing it away.
It's interesting because in your story, you kind of lament the Washington power grab that's gone on here. At the same time, you think the Fed should have been buying assets at a faster pace. Isn't that just more Washington intervention as well?
It would have been plain vanilla intervention if they'd done it as I wanted in October, November, December. If they'd bought a lot of MBS, they could have reopened the markets, but they didn't do it very effectively. They announced it in November and didn't even start until January, and then did it at only $25 billion per week, which simply wasn't enough to reopen CMBS, to reopen jumbo mortgages. So we've got massive swaths of the U.S. financial system today that still aren't operating. Small business lending is getting reduced, not added to. The housing numbers on Friday, people said, whoopee, existing home sales were up. A lot of it was cash sales, which out of foreclosures, which means a deleveraging. Where's the net add in cash if you've got people taking cash out of other assets and buying a dead house? There's no real net add.
I got to ask quickly, and we only have actually 10 seconds left, but if you're concerned that Bernanke didn't do the right things as far as asset purchases, how can you be confident then he'll be a good choice for the next 4 years?
No, but he effectively managed the Fed itself during a crisis, and so that means probably the best choice for now, especially if he works to stop this weak dollar trend that's sucking capital out of the U.S.
All right, David, thanks so much for joining us. David Malpass from Encima Global.